Trendline is actually one out of the many incredible tools in trading, but many traders use them incorrectly. The confusing part is that traders find ways to draw them differently, with some drawing them by connecting the wicks of the candles and others connecting the bodies of the candles. The question here is whether to wait for the price to touch the trend line and then you will enter in on a trade by expecting a bounce, or you will wait for the price to break the trend line and then anticipate a trend reversal to short the market. Despite trying too many approaches, the best way to trade trend lines has proven to be successful, leading to so many significant profits. This video will reveal the best strategy to trade the trend lines, including an in-depth tutorial on drawing them properly on a chart. If you happen to find value in this video, please make sure to click the like button, subscribe, and turn on the notification bell to get notified when we upload new videos like this one. Now let's jump straight into the video.
So, a trend line is a straight line that's drawn in on a chart that connects two or more swing points in price, helping us identify the market's direction. Let's take a look at an example. On this chart, the price moves up and down repeatedly, creating fluctuations. With all these movements, how can we determine the market's overall direction? The answer is simple. We draw a trend line. By connecting the swing lows with a straight line, we observe that the trend line slopes upward. This indicates that despite short-term price fluctuations, the overall market trend is moving higher. Now let's consider the opposite scenario. On this next chart, we again see price fluctuations with movements both up and down. This time, when we draw a trend line connecting the swing highs, we see that it slopes downward. This indicates that despite short-term price fluctuations, the overall market trend is heading lower. You might be wondering, can't we just tell where the market is going by looking at the chart? Why do we even need trend lines? The answer is simple. Trend lines do more than just reveal the trend. They also help us identify trade setups that we might otherwise miss if we were analyzing the chart with the naked eye. Here's a perfect example. Take a look at this chart. We've drawn a trend line by connecting the swing lows. Now notice something interesting. Every time the price touches the trend line, it bounces off. This tells us that if price comes back to the trend line in the future, there's a high probability it could bounce again. So what's the trade setup here? Simple. If price retraces back to the trend line, we could look for a buy opportunity to catch the next move up. But that's not all. Trend lines have another powerful use. If price breaks through a trend line, it could be signaling a major shift in the market direction. Now let's check out this chart. We have drawn in a trend line by connecting the swing highs, and it's clear. The market is in a downtrend, but look what happens here. Price breaks above the trend line. And shortly after, the trend shifts from a downtrend to an uptrend. Now, knowing this, the next time price breaks out of a trend line during a downtrend, we could set up a potential buy trade to catch the reversal. But here's the catch. Real trading isn't that simple. The examples I showed you are ideal scenarios. In reality, we can't just blindly enter a trade every time price touches or breaks a trend line. These patterns rarely work on their own. To increase our chances of success, we need to combine trend lines with other key concepts like price action. And don't worry, we'll dive into that later in the video. But before we even think about trading with trend lines, we have to know how to draw them properly, because if you get this wrong, no strategy will work. So let me break it down step by step. Now, the first step is to identify swing points. A swing point is simply a spot where price moves in one direction, then reverses. For example, check this out. Price drops down, then suddenly bounces back up. That lowest point before the reversal, that's called a swing low. Our job is to find as many of these key swing points as possible. In this case, we can already see multiple swing lows on the chart. The second step is to focus on major swing points. Now here's the trick. You don't want to mark every tiny little swing. Instead, only focus on the major, obvious ones that stand out. And finally, the last step is to connect the swing points. Draw a trend line, we need at least two major swing points, and in this case, we have more than enough. Once you've spotted them, simply draw a straight line connecting them, and boom, that's your trend line. Now that we've got that down, let's move on to how to actually trade using trend lines, because this is where the real magic happens. One of the most common questions people ask is, should I draw my trend lines using the wicks or the candle bodies? The answer is whichever gives you the most touch points. Let's look at this chart. If we draw the trend line touching the wicks, we get 3 touch points. But if we draw it using the candle bodies, we get 4 touch points. Since our goal is to get as many touch points as possible, in this case, we will use the candle bodies. A big mistake traders make is treating trend lines as rigid, precise lines, but in reality, they should be seen as zones or areas. If your trend line is slightly higher or slightly lower, it's still valid as long as it stays within the general area of the swing points. Now, don't overthink it. Trend lines are a guide, not an exact science. Now, let's move on to how we actually use them to find winning trades. Let's take a look at the price action on top, and we can spot multiple major swing points here. So let's try drawing a trend line. We draw it like this. Notice something off. Some swing points are overlapping the trend line. That means this isn't the best way to draw it. But if we adjust it like this, now the swing points align properly with the trend line. This is the correct way to do it. Getting your trend lines right is crucial for spotting high probability trade setups. So always make sure they connect cleanly with the major swing points. All right, now that you know how to draw trend lines the right way, it's time to reveal the high probability strategy I personally use. Now, let's say you've drawn a trend line on your chart. You've noticed that every time price touches it, it bounces. So naturally, in the future, we might expect another bounce because we treat trend lines as key levels, just like support and resistance. But here's where most traders go wrong. Just because the price has bounced before doesn't mean it always will. Look at this example. The price respected the trend line in the past, and now it's touching it again. So you might think, perfect, time to buy. But instead of bouncing, price breaks right through. If you had blindly entered a buy trade here, you'd be taking a loss. And that's exactly why you need a better approach, one that filters out false signals and only gets you into high probability trades. All right, here's the exact trend line strategy I use to catch high probability trades. First, we need to identify a strong trend. In this chart, we can clearly see that price is in an uptrend, and we have multiple swing lows that we can connect. So we simply draw a trend line right here. Since the market is trending up, we expect prices to bounce off the trend line and continue higher. That means the only trend line we need to focus on is the one below the price. Secondly, we want to use the stochastic RSI for trade confirmation. Now, here's where it gets powerful. I don't just rely on trend lines alone. I combine them with an indicator called the stochastic RSI to filter out bad trades and boost accuracy. To apply this indicator, go to the indicators section on your charting platform and type in the stochastic RSI, and then click on this one to add it to your chart. And just like that, we're all set. That we've added the stochastic RSI to our chart, let's tweak the settings for better accuracy. Go to the indicator settings and enter these custom values. This fine-tunes the signals, helping us avoid false entries and catch better trade setups. Now let's move on to how we actually use this indicator to time perfect our trade entries. To find a perfect entry setup, here's what we need. We would want the price to start approaching the trend line and the blue stochastic RSI line crossing into the oversold zone, the bottom area of the indicator. Again, remember that trend lines are zones. As I mentioned earlier, trend lines aren't exact lines, they're more like zones. So the price doesn't have to touch the trend line perfectly. As long as price is within the trend line area and the stochastic RSI crosses into the oversold zone, the setup is still valid. Before pulling the trigger on a trade, we need one last confirmation, which is to wait for the stochastic RSI to cross back inside the oversold zone. And once all these conditions are met, you've got yourself a high probability trade setup. And I will then open a buy trade right here. And for the risk management, and then you will place a stop loss slightly below the most recent swing low. This protects us if the trade goes against us. For the take profit, set it at 3 times the size of the stop loss to maintain a solid risk to reward ratio. And if you let the trade play out, you can see that the price bounced off beautifully and hit our take profit. Now let's take a look at another example to really lock this in. So on this chart, we can see that we already have the stochastic RSI with custom settings applied. Next, we spot an obvious trend line by connecting these swing highs. Since the overall trend is down, we are looking for the price to reject off the trend line and drop lower. That's why we only draw the trend line above and not below. Now, we patiently wait for price to move up toward the trend line while the stochastic RSI crosses into the overbought zone. So, in this example, the price didn't perfectly touch the trend line. It actually broke slightly above it, but that's totally fine. Remember, trend lines are zones, not exact lines. Since price is still within the trend line area, the setup remains valid. Now, this area where price meets the trend line also aligns with a previous support turned resistance level. This is called confluence, and it's a big deal. When 2 key levels align, it increases the chances of price rejecting that area, making it an even stronger setup. Now for the final entry signal, we wait for the stochastic RSI line to cross back inside the overbought zone. Once that happens, we take a short position here. Then for the risk management, We will place our stop loss just slightly above the swing high for protection and set the take profit at 2 times the size of the stop loss for a strong risk to reward ratio. And if you play the price forward, you can see the price rejected the trend line beautifully, dropped perfectly, and hit our take profit. This is why combining trend lines, stochastic RSI, and confluence levels is such a high probability trading strategy. If you happen to find value in this video, please go ahead and smash the like button, subscribe, and turn on the notification bell to get notified when we upload high quality videos like this one. Thanks for watching and see you in the next video.